Understanding macro cues from natural gas industry. When you are trading natural gas and constantly trying to stay abreast of the information available on a macro scale from various energy industrial reports, you may come across terms such as interruptible contracts and firm contracts in the context of natural gas. So let's learn what are they, what importance they have in trading. The purpose of understanding this specific information is apart from the price graphs you see on natural gas futures, and what's this is all about what's really happening at the ground level. Though we expect the prices are determined by a free market in exchange, these OTC forms of contracts play a major role in influencing the price of natural gas in long term. Any contracts have two or more parties to the contract. Likewise, the parties to the contracts here are producer or supplier, pipeline operator, user, or power plant. So the natural gas transaction here has two major components to consider. One is supply component and delivery component. The transaction between power plants and natural gas supplies generally include a supply component, which involves an agreement with the fuel producer or the marketer to supply the commodity, and another part is delivery component, which involves an agreement with the pipeline operator to transport the fuel from the producer to the plant. In the whole deal, one or both components can be a firm or interruptible. In most cases, power plants rely on one type of contract, either a firm contract or an interruptible contract, for both supply and delivery component of the natural gas purchase contract. Now let's look at what firm and interruptible contracts are in the context of natural gas purchase agreement. Firm contracts provide a confirmed supply of natural gas to the power plant by the supplier. The fuel request by the power plant will be in the priority delivery. The supply or delivery of natural gas cannot be curtailed under a firm contract except under unforeseeable circumstances. In contrast, interruptible contracts, also called non-firm contracts, are lower priority fuel supply and transportation arrangements. Under these contracts, the flow of natural gas to a power plant may be stopped or curtailed if firm contract holders use the available capacity or if other interruptible customers outbid the power plant. These contracts are generally set up for short period, often the next day delivery or next week delivery, something like that. In conclusion, interruptible contracts are less expensive than firm contracts. This is due to the fact that high risk of disrupted fuel receipts. And in US, firm contracts are most prevalent in West and South region, while interruptible contracts are most common in Northeast region. Thanks for watching.